So what does the Dow Wealth Management investment strategy mean when put into practice? Let us show you. To keep our results entirely objective, we've prepared an illustration using well-accepted market indices for the 1993 through 2012 period. In other words, we are promoting an investment strategy that anyone could implement. It is not based on some proprietary secret formula. We start again with a typical retired investor who has a $500,000 portfolio, 60% invested in fixed income securities and 40% in equities. Next, we show the three ways by which he could make his investments. He could own them indirectly by purchasing variable annuities or mutual funds, or he could own them directly. Depending on which of the three investment vehicles he used, over the 20-year period, $500,000 invested with this 60-40 allocation would have generated returns of $823,000 if invested by way of variable annuities, $1.1 million if invested through mutual funds, and $1.5 million if the securities were owned directly. In other words, mutual fund investors earned about 25% less than direct securities investors, and variable annuity investors earned nearly 50% less. For this reason, Dow Wealth Management, all the way back to 1937, has never advocated the use of investment products. As we discussed in the Dow Wealth Management Strategy section, asset allocation is another prime determinant of investment success, and if we can justify a large allocation to equities by virtue of reducing the risk of an irrecoverable portfolio loss, we might greatly increase our ownership of this high-return asset class. When we do so, we see that investor returns have been enormously magnified. $500,000 invested in directly owned, high-quality securities over this period might have been expected to return $2.7 million. That is 80% more than our typical direct securities investor, nearly 2.5 times more than a typical mutual fund investor, and 3.3 times more than the typical variable annuity investor. If we were to add in the growth component previously discussed and adjust for the tax advantages inherent in direct securities investing, return disparities could have been even greater. As well, because the returns used in this illustration are those of indices, they do not even presuppose the potential enhanced returns that may be provided by professional portfolio management. As an important caveat, note that the historical returns used for bonds are well above current rates. Therefore, it seems unlikely that bond investors will enjoy such high returns in years ahead. In fact, they should expect to suffer losses when interest rates rise. In our view, then, mutual funds and variable annuity investment products are far from optimal for their buyers, and even direct securities investors may significantly improve their returns by adhering to relatively few principles of investing.